Hi, everybody. My name is Lisa Billings. I'm with Warren Averett and their tax division here in Birmingham, Alabama. Here at Warren Averett, we are a firm of about 800 people all across the Southeast that specialize in a lot of various industries. Today, we really want to focus on one industry and talk to some very knowledgeable industry experts. We have Will Aderholt and Claiborne Morris here who lead up our construction industry group and are construction specialists. So welcome.
Hey, Lisa.
All right. Thanks, Lisa.
All right. So I know today we want to talk about one big, beautiful bill and how that affects construction. And I know one thing that people have started hearing about a little bit is, qualified production property. Tell us a little bit about that and really how that affects the construction industry.
Yeah, Lisa, I think this is going to be a huge provision that's going to indirectly affect contractors and sort of set the scene on where construction has been. We're kind of riding a wave of a big 2024. Most contractors had really good years, and 2025 seems to be slowing a little bit. We're kind of seeing some headwinds between, labor shortages, tightening immigration policy, tariffs that put uncertainty on material pricing. There's a lot of uncertainty out there, a lot of jobs that are stalling, but there's also a lot of tailwinds, and one of those is this qualified production property provision that's in the bill. So to talk a little bit about that, this is a provision that allows a business to expense a manufacturing facility if it meets the qualifications. And one of those is it has to be essentially new construction. The manufacturing has to commence with the taxpayer that places it in service. So with new construction means contractors are going to be building these facilities. What I read, and economists think that this might have a $5 to $8 trillion impact in construction spending in the industrial sector. So that's way more than what that sector has seen in the last 2 years. So this could be huge for contractors.
Yeah. You just think about, we're going from the reality of if a big technology company builds a chip plant that costs $400 million, we're going from them spreading that depreciation over presumably 39 years
Yep.
to being able to deduct it all in 1 year
Yep.
for domestic manufacturing. So you can imagine, just how much that could sort of push. It makes projects pencil a lot easier for a lot of these manufacturers who are, considering coming back onshoring because of the tariffs and all those other things. There's a lot of sort of momentum sort of headed that way that I think will have a big impact on the industry.
Yeah, it'll be interesting to see if the industry has the resources to support that kind of demand. I mean, you would expect a lot of opportunity to build these types of facilities. Maybe you got contractors that, hadn't really dabbled in that sector very much. Now you might want to take a look at these types of projects, because there's going to be a lot of demand to build these in the next 2 to 3 years. I think construction's got to start after January 19th of 2025. So, these contracts that were previously had a written and binding contract prior to that date aren't going to qualify for this, but, projects that are commencing at least a binding agreement after that and shovels in the dirt after that are going to qualify.
Yeah. And, the other thing we talked about is the QPP provision really ends, the construction's supposed to be complete by the end of 2030. So you've sort of got a small window, especially for some of these really large industrial onshoring projects, that they should be feeling some urgency in getting those projects moving. So hopefully this will have an impact here, in the short term.
Mm-hmm.
Absolutely. I think that is key just as we see how this starts to be applied. But I think it's something to keep in mind whenever, you're talking to industrial clients, and this is a way to hopefully help fund their construction cost.
Yep.
So we've got a few other things that came out of the big beautiful bill. One of them is, that I think is huge for, residential contractors is percentage of completion method. Do you want to talk a little bit about that and
Yeah,
how that's going to apply?
absolutely. So it'd probably be helpful to have some background on what the law was prior to this provision, and that was really contractors that exceeded a certain size in revenue, around the $30 million mark, had to be on percentage of completion for their tax accounting method. So really what that means is you're reporting taxable income along the way. There's not much opportunity to defer taxable income. Now, there is an exception if you were under that threshold or if you were doing home construction contracts, and that was defined as a building with 4 or fewer dwelling units. Okay, so if you were doing those types of projects, no matter how large you were as a contractor, you did not have to be on percentage of completion on those contracts. Now, you had contractors out there that were building multifamily, so it was residential, but it didn't quite fit the mold of home construction contracts. So those, unfortunately, you had to be on percentage of completion on those if you weren't if you were exceeding the small taxpayer threshold. Um, what that what this provision is doing is it's eliminating the distinction of a home construction contract and really pulling those residential contracts under that umbrella to where contractors who are building, big multifamily projects are going to be allowed to not have to report income on percentage of completion, just meaning you have options to defer more taxable income on those types of contracts. So this is a really welcome change for contractors that are doing multifamily, senior living, student housing would a lot of times qualify. It just can't be hotels or anything where the inhabitants are, a temporary transient basis. It's got to be more of a permanent dwelling. So it's going to be big for contractors to look at it. But this only applies to contracts starting in tax years after July 4th, 2025. So, Lisa, most contractors aren't going to really be able to take advantage of this. If they're a calendar year taxpayer, you'll start to see it in 2026. But it's definitely something to take an eye on and look at the contractors' WIP schedules and see what types of projects they're doing.
Hey, Claiborne, does that qualify? Would that qualify? Like, so let's say clearly you would think about a general contractor that's building multifamily. Would it also apply to the subcontractors working under the general on that job?
Yeah, that's a good point. And this would apply to subcontractors that are working on that type of contract. So, if you're a roofing contractor, site work, if it is involved in ultimately a multifamily project, that's going to be considered a residential project for that contractor.
Should be great opportunity to
Yep,
defer some income.
right.
Absolutely. So there were a couple other provisions in the bill that I think probably help all business owners. You want to touch on some of those a little bit just to see, kind of cover some of the things that we think are big for construction companies.
Yeah, Lisa, the other thing that comes to mind for me is the Section 174 R&D capitalization rules, and I think we probably need a history lesson for some folks that may not have heard of this, but I'll try not to bore you too much. But if you sort of go back in time to the Tax Cuts and Jobs Act of 2017 that was passed under Trump's first term, there were some provisions built in there to raise revenue on the back half of the bill so that it sort of fit within the budget window and it could be passed the first time. And one of those things was that R&D costs that had always been deductible in the year paid actually had to start being capitalized and amortized over 5 years for domestic research and development cost. And you may think, hey, that doesn't affect contractors, but we do have a lot of contractors, architects, engineers, design professionals that take advantage of the research and development tax credit.
Yeah.
And so prior to this does affect them. So, and to kind of going back to that history lesson, prior to 2022, they could take the R&D tax credit and they could also deduct the payroll expenses and other expenses that sort of gave rise to that tax credit. So it was sort of almost like a double benefit. Beginning in 2022, you could still take the tax credit, but now you have to spread those primarily payroll costs over 5 years. So it was a huge cash flow mismatch that we've been working with clients on ever since 2022. There's been a lot of political activity around this. And so the good news is that they did finally, in the big beautiful bill, um, take us back to sort of that old regime where now you can, should you elect to, you actually have options now, which I'll talk about. But you can go back to deducting those costs in the year you incur them instead of having to capitalize them and spread them over 5 years. So again, so we're sort of back to where we were, where we've been hoping that we could get to for the last few years.
Will, is there any talk about maybe some opportunity there as far as electing to capitalize it and how that might affect a contractor?
Yeah. So, and there's sort of two groups, I would say, sort of distinct groups that, that we see that take advantage of this that really affected them. You've got more of your sort of design professional that's, maybe cash basis accounting, accrual basis accounting, but they're not on percentage of completion, right? So that'd be more of an architect or an engineer, service professional type person. Usually they're going to benefit from this because they'll want to go back to the way it was where they can just deduct the cost in the year they pay them. When the bill changed, what we found is that our contractor clients that were on percentage of completion method, they actually benefited from having to capitalize those job costs. And so the bill, in a nice way, sort of allows you to do both, right? So if you're sort of an architect engineer that this was really detrimental to, you can go back to deducting them. If you're on percentage of completion as a contractor and it was actually beneficial to you to have to capitalize them, well, you can continue to do that. So you sort of have the either or. And it probably makes sense to talk about kind of how this is going to treat the costs that had to be capitalized in prior years.
Right. So the costs that had to be capitalized in prior years, you got a few different options. You can amend. If you're a small taxpayer, you can go back and amend prior returns and take and deduct those costs and be eligible for refunds. Or if you don't fit the small taxpayer bucket, you have the option to deduct the unamortized basis in tax years starting after 2024, 12/31/24. So, some of those fiscal year taxpayers, you might have to delay it another year, but most calendar year taxpayers are going to have the option to deduct those capitalized costs that they hadn't deducted prior all in 2025, or you have the option to spread it between 2025 and 2026. For contractors that are on percentage of completion, it's going to be really important to look at this. Maybe some of your contracts aren't long-term contracts and they start and finish during the same tax year. You might want to look at actually deducting those R&D costs. But for contracts that cross 2 tax years where you're on percentage of completion, the ability to capitalize that and slow down that percentage of completion revenue recognition might be helpful. So it's just kind of something that we'll have to look at on a case-by-case basis.
Yeah, it's definitely going to be digging in and looking at contract by contract basis, sort of what the more beneficial way to treat them is. So should be fun.
I'm just happy that for once they actually used some common sense and gave us some options. Since they have changed this around several times, now we can at least look at it and be able to do some planning around this.
Absolutely.
So a few other things that are out there, tell us a little bit about bonus depreciation, the changes to that, 179, those seem to be, some big ones along with QBI. I mean, that was a big win this time.
Yeah. Lisa, to me, with that last point, the QBI was the big one that we were looking at. We've been keeping an eye on this potential tax reform for seems like over a year, because what was going to happen was these provisions were going to expire had Congress not have taken an affirmative step to extend them. And one of the most detrimental, if it had expired, was that qualified business income deduction, which is for pass-through entities, S corps, partnerships that ultimately go to an individual. They were allowed a 20% deduction on their share of the business's income. So basically meant that they could be only paying tax on 80% of the income. So that actually got permanently extended, which we were thrilled to see. That allows a little bit more certainty on planning, and that was a big welcome to see that was extended.
Yeah, I mean, the reality is with if the provisions of the Tax Cuts and Jobs Act were allowed to sunset, which is what was going to happen at the end of this year if this wasn't passed, most of our clients that operate as S corps or partnerships were looking at a 10% rate increase from 29.6 to 39.6. So, this is really sort of that status quo. We really got an extension of what was the status quo, but it was a very big deal.
Yes.
Yeah.
All right. Another one of those provisions that we were glad to see extended was bonus depreciation. That was without any action taken, that was set to go down to 40% in 2025 and 20% in 2026. So obviously, bonus depreciation allows you to expense it all that percentage in that year. So what changed in the bill is property that was under contract and in service after January 19th, 25 is eligible for 100% bonus depreciation or 100% expensing with no limits. So that's really good to see. And, that affects a lot of contractors out there, heavy equipment contractors, site work, those types that do a lot of CapEx during the year.
Absolutely.
Right, that machinery can be written off, so, I mean, that's always a great benefit. So a few other things just in the bill, we've talked about a lot of good things because there were a lot of very business-friendly provisions, but, everything has to have a revenue raiser. So tell me a little bit about some of the revenue raisers that you think will affect the construction industry.
One thing that comes to mind for me, I've worked with a lot of contractors that are very charitable, charitably minded. And, one thing that was included in the bill that is a little detrimental is that there's really two ways that charitable contributions are sort of going to take a haircut in terms of the tax benefit they provide. One is that charitable contributions just in and of themselves, there's sort of a provision that takes a 0.5% haircut off of the charitable deduction just right off the bat. Not huge, but it's something that are just going to make those charitable contributions a little less valuable from a tax deduction standpoint. The other thing is that there's an overall limit on itemized deductions for taxpayers. It's complicated, but at the core, it really doesn't allow a taxpayer who's in the top bracket, the 37% bracket, to be able to deduct their itemized deductions at 37%. They can only get a 35% deduction against their itemized deductions. That's all itemized deductions, not just charitable.
Well, you want to talk about maybe when some of those provisions apply and maybe some planning you can do in 2025 to help with that?
Yeah, absolutely. So those provisions go into effect on January 1st of 2026. So, for a contractor or really any client who is charitably minded, it may make sense to go ahead and bunch contributions into the end of 2025 just to get that full benefit. A lot of our clients use donor advised funds to be able to do that. And then, subsequent to that one opportunity, we're going to be back to looking at, does it make sense to bunch your contributions in 1 year and less the next, and that sort of thing. So there'll be a good bit of planning around that.
Yep. Lisa, another revenue raiser and kind of the general theme that you'll see in this bill is a lot of these green energy incentives are being peeled back or repealed. One that comes to mind that really affects a lot of contractors that do design build work specifically is the 179D deduction.
Yeah. In addition to that, there's, like you said, there's really just the whole theme of this is energy, sort of green energy, green type credits either being substantially reduced in their benefits or going away altogether. I know we have clients home builders that take the energy efficient homes credit. That's going to be repealed. A lot of solar credits are being repealed. That may not directly impact contractors per se, but I know I have clients that are working on solar jobs, solar projects that, may not as easily pencil anymore. So, that'll probably have some downstream economic effects that we'll have to wait and see. But yeah.
One thing that's gotten a lot of attention that really affects business owners is the exemption on overtime pay. I know we've gotten a lot of questions about how is that going to apply? What do we need to do? When does it start? We know for employees, it's really, they'll deal with it at the end of the year. But what about for business owners?
This is a big one in the construction industry, is the deduction for overtime pay, because you got a lot of laborers, employees that get overtime wages, and now if they are within a certain tax bracket, they're going to be able to deduct up to $25,000 against those overtime wages. And this is, to be clear, if you're paid time and a half in overtime, this is really only on the half increment of the overtime pay, but still a good tax incentive for employees out there that are working overtime.
Yeah. I think, Claiborne, one question I've been getting a lot from our clients, not necessarily the employees, but the employers, is, well, hey, how do I do this? Is there anything I need to be? Do I need to not be withholding taxes on that overtime? What do you?
Yeah, and since they rolled this out in the middle of the year, they're allowing employers to use a reasonable method on overtime that they might have paid prior to this bill. And so, you have a little bit of flexibility in determining how much overtime you paid these employees. And, starting in 2026, we're expecting new withholding tables to roll out to where that'll be adjusted.
Yeah. And I did see the IRS came out maybe last week and put us on notice that they're not going to update the withholding tables this year. So we are going to have to wait till January.
Anything else that we need to know for business owners that came out of this bill?
Yeah. Lisa, one thing that comes to mind is the estate and gift tax exemption. So as a lot of folks know, that exemption was set to be cut in half beginning next year. And so we had a lot of high net worth business owners and clients that were worried about maybe needing to do some estate planning before the end of the year, before that exemption got cut in half. So the good news is that it did get permanently increased to $15 million per person. So that'd be $30 million for a married couple beginning on January 1st of 2026. And that is indexed for inflation going forward.
Mhm.
And so, we do have some certainty around that. That's been, when it got increased in 2017, it was temporary, sunsetted. So there's a lot of uncertainty now. Hopefully we have some certainty around that, at least.
As permanent can be.
That's right.
Yeah.
And tax law and politics.
And one thing to note on that, Will, we do a lot of succession planning projects. And so, this is always in the topic of that conversation. What is the successor? What does the estate plan look like? And now, if you've got somebody who might have a taxable estate, well, you've really got another $1 million of a bump starting from 2025 to 2026. So you've really got another $1 million of wiggle room starting in 2026 that you have to play with.
That's right. So even if a client did, because there's been various stages of, we thought that the exemption was going to decrease a lot. So we did have a lot of clients that really sort of gave as much as they could. So this may be, we have clients that are in that situation, this may be an opportunity for them to maybe look at it again with that increased exemption amount.
Mm-hmm.
Well, Claiborne, Will, this has been a ton of information for contractors. If I'm a contractor, what do I need to do next? What do I need to do with this information?
Yeah, that's a great question, Lisa. I think, clearly, I think it's a year where we need to do maybe earlier year-end planning, because there are some opportunities both to put some strategies in place before the end of the year, and both from a planning standpoint, just in terms of knowing what your tax liability is going to be next year. But then also, there's a few things that you probably should do before the end of the year. So if we, think about the things we talked about, the change in maybe the ability to recognize contracts not on percentage of completion. So that's something we need to be looking at right now on a contract by contract basis and making sure we understand really what the underlying work is in a contractor's WIP schedule. There's, we talked about the charitable contributions. That's something you may need to do a little bunching, planning before the end of the year.
Yeah.
Should that be beneficial to you? The Section 174, the R&D expense, making sure that we understand kind of which method, because now you have options. And so, what option is going to be the most beneficial? So I think that was a long-winded answer to say, call your Warren Averett advisor and let's sort of do some planning earlier this year.
Yeah, and I think each approach, there's not really a cookie cutter answer to this. I think it really is a case by case basis that you really got to dive in and look at for every contractor. I mean, it could be different for each one. So really kind of modeling things out and looking at some of these new incentives and how we can take advantage of it. Like you just said, it's kind of a case by case basis.
Yeah, and I mean, this is off topic from a tax standpoint, Lisa, but I think another thing, is really look at your backlog and your capabilities. Like we talked about, there's certainly a theme of incenting domestic manufacturing, bring onshoring, and if you're not in that world right now, it may make sense to kind of pivot and start doing some business development for owners in that arena. I think, all signs point to there's going to be a lot of work coming through the pipeline.
Yeah, and even if you're working on projects and you might compete with another contractor that does some manufacturing and some not, well, that contractor might be tied up doing a lot more of this industrial work and really free up you to go after some more short list bids. And it really could affect contractors that don't even do these types of projects, just because it's going to draw so much attention for contractors that do build these manufacturing facilities. So it's going to have a wide-reaching effect.
That's right.
Well, Claiborne, Will, thank you so much for coming today and educating all of us on construction and how this new bill can affect our contractors.
Absolutely. Thanks for having us on.
Yeah, enjoy it, Lisa.